Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. It's the first show after the union budget, and therefore we are trying to get in as many queries around the budget and the implications of that answered. Add to that a few other questions which will be posed to our experts. Both of them in no introduction have been on the show before. Vishal Kapoor of IDFC AMC and Kaustaubh Belapurkar of Morningstar Investment Advisers join us on the show. Gentlemen, both of you, thanks so much for joining in. There are a lot of specific queries, but just an initial broad brush. What did the budget throw up for you from a mutual fund perspective? Either of you can start.
I think on the mutual fund side, no major changes is one way to look at it. So I think the industry has been doing well. We hope to continue to do well.
Yeah, so I would kind of mirror what Vishal said. So not direct sort of changes per se. I know there was this wish list that was drawn, and I don't think anything of those were really directly sort of addressed. But yeah, I mean, there have been some incidental changes given that, which we talk about in due course.
Yeah, okay. So let's start, cut the chase and get straight to the point. 3 or 4 things, and I'm just putting it up on a random order without laying down on the order of importance. The taxation of dividend at slab rates versus DDT. Now, a lot of individual stock investors have said that, from an Indian perspective, that this is and this increases the tax incidence. From a mutual fund perspective as well, how do you think this impacts funds, the returns to investors? Vishal?
So firstly, yes, I think for affluent investors, which is therefore on the higher tax brackets, it may make sense to be in the growth plan rather than the dividend plan, because earlier this was quite clean, it was tax-free in your hands, and the tax incidence was relatively low. Now that it's coming to you, you have to not only pay your marginal tax rate, but also worry about the paperwork and everything else involved to compute it. So it's not just the amount, but it's also the administration of it. So the growth plan is simple and clean. And if I look at our book, the bulk of our investors, in fact, almost 90% are already in the growth plan. So that was in any case the more popular one, which is why I'm saying it is a change, but it's not that material. But yes, if investors who are affluent, who are in the dividend plan and don't need the cash, could move to growth plans. If you need the cash, a systematic withdrawal has always been a far better way for you to control your cash flows.
I guess you would second this, Kaustaubh, but as Vishal said, for there, maybe a large proportion of the investors were anyways in the growth plan.
That's right.
I mean, maybe it's a difficult one to assess, but is that the larger industry piece as well? And what are your thoughts on this?
Yeah. So if you just look at the data, right, in terms of, if I look at specifically, and I can actually break it down to asset classes, but if I look at equity schemes, clearly maybe about 10 to 15% was in the dividend plan, cross asset managers. In the balanced category, I suspect that number would be a lot higher, given the way some of these were structured to pay out regular dividends. So that's where it's going to be the challenge, where, like Vishal said, that if you're an affluent investor, especially in category like equity, where you can then pay a 10% LTCG, be better off doing that. So you'd want to move to the growth plan. But investors who are in the dividend plan to move, that's the other thing they need to keep in mind in terms of that switch. How do you do it, and the tax implications of that when you come about doing that.
But even if accounted for that, it might still in the long run be better to actually switch to that plan as opposed to stay in a plan, right?
That's right.
Accounting for the tax implications as well. The other bit is this clarification that came out last evening, wherein I think it's now mentioned that the 10% TDS on mutual fund income above 5,000, it's only on the dividend and not on capital gains. Is that, I would presume that's a big relief. I mean, though most people said it would be logical that way, but there was still clarity needed here.
Yeah, so there was some interpretation that was doing the rounds after the budget was announced that, does this or does this not? And I think it's good to have the clarification that redemptions or capital gains are not subject to TDS. So I think it's just good to have that clarified in black and white.
Yeah, do you guys believe, just hypothetically now, but do you guys believe that should that not have been the case, though it's very unlikely that that the government, even by intention or otherwise or by mistake also intended that way, but should that not have been the case, would have been a major impact on flows into funds in any fashion whatsoever?
You mean if there were TDS on capital gains?
Yes.
Yeah, so we have to keep in mind that any form of TDS traditionally has been seen as a deterrent across many other products. So I guess it is speculative to imagine why it would be the case, but it's good that it's not. So
yeah, it's good that it's not. Yeah, I'm just throwing this argument simply because for 2 days, Vishal, following that, from the time I got off the chair after finishing the show on Saturday, besieged with talks about why is it that this is the case and what would happen. I'm glad that this clarification came about, even though a few of the CEOs were of the belief that this would be the case. Okay, the other bit, and Kaustaubh, the noise is larger around the insurance side, and I think insurance company after insurance company has come in and said that this will not impact, but from an ELSS perspective as well, the options available for investors to move to a new tax regime.
Right.
Now, it means that investors who wanted to save tax necessarily do not have to opt for ELSS with a presumption that it was the best available option any which ways. Do you think this has the power to change what used to typically happen between Jan to March, wherein a lot of people opted for ELSS schemes?
Right. So, we've spoken about this, that
yes, we used to do a show every year.
There used to be a mad rush in exactly the last 3 months where people would kind of move. Obviously, over the last few years, seen more steady money coming into ELSS. But if you ask me, I think there is going to be an impact. To what extent, I don't know. But, if I were just to look at the numbers, given that, there will be a large set of investors, who would probably look at the new regime as more beneficial in terms of either absolute tax saving or just instant gratification and having more money in their hands, can potentially opt for that, which means, ELSS doesn't become like a forced, not a force, but, it was something they would do because they could save tax. If that option doesn't exist, flows in that could kind of, dry up, because that's the retail investor base. The sheer numbers would add the flows to the ELSS. Because, your HNIs, even if they had some allocations to ELSS, the numbers are much smaller from that. So to my mind, I think there will be an impact in terms of the flows on this category.
Okay, Vishal, would you, and I would want to dwell on this a bit because this is important.
Sure.
To your mind, in your fund house at least, is there a breakup of any sorts that what's the, I'm guessing it's difficult to figure out how many people below 15 lakh rupees annual income would be investing, etc. But is there a breakup of sorts about investor behavior towards ELSS, whether it's a high income category, low income category, whether it's by default or otherwise? Any thoughts here?
Sure. So I think there are a couple of things I want to just lay out.
Lovely.
Firstly, I think going in, we have to reiterate that the purpose of investment should be meeting your goal, wealth creation, growth of capital or income, etc., rather than just merely saving tax. And I'm highlighting this because often one finds that the behavior for investors, not just in mutual funds but overall, tends to focus on the tax benefit over the underlying. And you can make your first error there. The purpose itself of the investment is lost or relegated to the back end, and tax saving becomes the primary goal, which needn't be the case, firstly. Now, coming to ELSS, it's a great category not just because of the tax benefit under 80C, but also because it allows you to benefit from at least 3 years worth of capital growth. It's granular, and over time, I think a lot of happy investors have been generated for the industry because their experience out of ELSS was so positive. So, you've got a 3-year investment horizon locked away, and then at the end, you're converted you see the benefit of staying long-term in equity. So that's the second point I want to reiterate. The third is coming to the immediate impact, because this section may or may not be now availed of. I think 2-3 points to keep in mind. Firstly, while it is a valuable category for the industry for some of these reasons, its absolute size relative to the industry is still quite small. I think if I recall, it's about 105,000 crores out of a 27 lakh crore industry. So just 2% or 2.5%. Even in terms of flows, it's granular, it gets a lot of retail investors, but in absolute size, it's still under 4% or so. So on a relative basis, it's not going to significantly disturb the industry structure per se.
Okay.
The second thing we have to keep in mind is that most of the investors into ELSS products or the 80C beneficiaries are largely the salaried employed and affluent plus. And from whatever calculations we've seen so far, this block of savers and investors are likely to continue with the exemptions, because it's not just 80C, there's the HRA benefit, LTA, and the other benefits.
Yeah,
so
all of
on
that.
the whole, from the calculation of the maths we've seen, non-employed and the lower tax-paying investors or savers may be the ones who will choose to be in the new scheme rather than in the old scheme. And the ELSs, the bulk of ELS investors, to my mind, are in the category where you will continue to go with the exemptions.
There's no data that you have here. It's a belief of the investors that would be there within the industry or within your house.
That's right. This is just talking to our partners, distributors, looking at some of the data, etc. And what's the average ticket size, so what's the implied sort of earnings of that individual, and therefore what's the tax bracket the person is likely to be in. And that, I would think, would imply that most of these investors will be in the higher tax slabs and employed. That's important, because it's not just about ATC, it's about the other benefits. So if you're employed and you have an HRA benefit, are you really going to give that away now and go into the new tax slab? And in many of these calculations, it may not be as beneficial to you.
Well, so that is one pertinent point. Kaustaubh, the other factor is, when I asked around my office as well, because we have a lot of, and the average age is very young out here, and a lot of them millennials who might be around that income bracket wherein this decision may make a material difference either direction. So one point where I think the large sample size agreed with Vishal's assessment was that there are other benefits available as well. Not everybody has a house, but people are living on rent, and therefore all of that benefits. The other point is, though, that most said that while they make the mutual fund investments, which is ongoing, over and above the mutual fund investment, which was goal based, they used to make an ELSS investment because it was necessary. Now, I'm guessing it's difficult to figure out because people may not move, but if they move to this, then the ELSS investments will, in all likelihood, take a hit. The question is, it might be a very small fraction of the overall investing population.
Right. So, a couple of things, and I'll actually touch upon what Vishal alluded to, some very pertinent points. So, if you look at data globally also, right, not in like example, but if you look at the US, the forced investing, the 401k sort of, not the forced, but where you get benefits, 60% of new investors, their first investment came in through a 401k plan. So in that sense, ELSS was this beautiful thing where, you had that carrot to come in and invest.
Right.
And then you got used to this, beast called mutual funds, equities, and they stayed at least for 3 years, which generally gave them a much better experience than, maybe looking to redeem in a shorter term. And then obviously they kind of graduated to other. So I'm hoping that, at least for the guys who've already tasted investing in, asset classes with equities, nothing really changes. It's either ELSS or continue to do it. Even if they say, they take the new, they qualify, they think that the new exemptions or the non-exemption tax slabs are the good ones for them. They'll still come into investments, hopefully, equity investments, maybe not necessarily through ELSS. That's my, my first sort of point. It's very hard, and like Vishal was saying, right, that there are exemptions that are available, beyond your ATC. It's just not your ATC. So the threshold, if you just do a back of the envelope calculations, about 2.5 lakhs of exemptions. If you're availing right now, then you're kind of indifferent between the two regimes. So that's really the call that each investor needs to take. But my point is that any guy who's coming in new, who's not been exposed to it, needs a little bit of handholding or that incentive to come into the investing space.
Yeah.
In a way, I think maybe that part has, at least a bit of that carrot's gone away. That's my thought around that.
Yeah, Vishal, just that investor behavioral perspective as well. So if let's say I'm at a number which is not too low, just about anywhere between 14-15 lakh rupees of income, and because if I make the switch, I can't come back. That's what at least I heard the FM say as well. I might not be tempted to move on to the new regime because I would fear that when my income grows and I get a lot of other exemptions, I may not be able to move back. So that is valid. So maybe the detriment to or the impact on flows may not be too much because the only ones who might actually move out are the really low income guys. But the point is the whole idea of catching them young and getting them into the ecosystem, does that stand a chance of getting impacted?
Yeah, so I think of course, only time will tell. So I think this is a new idea. And if I look at it, what it does do is give more cash in the hands of this younger and therefore, the new saver or employed, which does boost demand. So keep in mind, one of the other imperatives that the industry was asking about from the budget was how do you get more consumption going? And to some extent, the budget always is a bit of a balancing act. You've got many requirements. So at one level, yes, it does create a bit more of a consumption spur. because so much money does not have to be locked away, in a sense, into longer term investments, etc., and you can spend it. But on the contrary, and therefore the flip side, which is, I would caution many of these young savers that yes, it may look very attractive to spend this money, etc., but then all of the benefits of long-term investing, start early, staying longer, etc., is something you have to be careful about. So I think as an industry, we have more work to do to spread our message and get some good savings and investment habits inculcated, because we do also need long-term capital to fund, capital growth. So to that extent, yes, yes, an incentive is always sweeter, but without the incentive, we just have to work harder and get these investors to look at the longer-term picture.
Yeah, well, hopefully that happens, and yeah, I think the message is well taken. You come into the investment with a carrot, maybe, but idea is to invest and try and build up. I mean, either goal-based or otherwise, but try and build up that investment as opposed to coming in for a particular short-term one-off advantage that you get in any form of investing, let alone mutual funds. The other point that I wanted to talk about before we also talk about a new fund offer from the IDFC stable is a proposal which is likely to happen that SEBI might look at reclassification of mid-cap and small-cap mutual fund schemes as well. And here I know for sure that the industry is debated, because I've spoken to 3 or 4 of mutual fund CEOs in the last 6-7 hours. And a couple of them believe that this was a great time to do. A couple of them believe that we were getting used to, so it's okay. I wanted your opinion on what this means. Kaustaubh, can I start off with you on this?
Sure. So actually, that's kind of a mixed bag, in the sense that obviously we've been now, been in a little more than a year and a half, in the sense that, and rightly so, that been used to a classification system. But the problem, especially if you look at it in the mid caps, has been that now there are 2 ways of looking at it. One is that you have a stock universe of 150 stocks, particularly in the mid caps. Some might have thought that that's a constrained universe. But obviously to the point that, when the mandate for the fund allows you that 35% outside that, so it's not that constrained as it seems. But as the category grows, that's one of the challenges that it can be, in terms of just that, concentration towards those X number of stocks. And not necessarily all of them would be stocks that would meet investment merits, in portfolio. So that whittles it down to a much lower number. But obviously, like I said, the flexibility is there, because it's only 65% of the portfolio, not beyond that. So that's really where. So it's kind of, it'll be nice to maybe have a little more flexibility. Yes, that's something. But so far, I think it's worked okay. There were concerns that how would it hamper, some of the large size funds in terms of flexibility. I think, but largely it's been well contained in that sense.
Okay, Vishal, you have any thoughts here? I mean, because it's been some time, as Kaustaubh said, I think a year and a half that we've been used to this now, and there is a change. I'm not saying it's not a positive change, it may well be a positive change, but your fund house experience with the classification as it stands right now, and if indeed there is a change, what could happen?
I think one, it's still a discussion. It's
agreed,
still
completely
not,
agree.
Cast in one sense. Second, when we first looked at it, and one way to do this would be to look at chunks of the market cap and look at what the international experience have been in developed markets, etc. What proportion is classified as large cap? What proportion is classified as mid cap? I think there may be some room to expand the mid cap area, and that was one part of the feedback for the last 18 months as well. That maybe 150 stocks may be too constraining for the real mid cap space to develop. And when you have got 65% of a mid-cap fund concentrated in the space, do you really have enough width or not? So to that extent, some amount of expansion may be welcome. But of course, with any change, one has to look at what's the portfolio impact. And there is adequate room in the fact that there is the other 35% that fund managers have to balance out any such change or movement and not have an impact cost. So yeah, should there be that path or that step taken, which is you expand the mid cap to 200 or 250 or wherever that lands up, I think structurally it's better for fund managers because there's more room. At a fund level, of course, every fund manager will have to make sure that the impact cost is not too much. And as an investor, you would then look at what's the change, if at all, and does it change the product that you bought into? In most cases, I would think not necessarily, but you still have to be careful about that.
Yeah, you do. And it's in these interesting times that while there might be changes as well or otherwise, but also the fact that January was such a different month for equity markets compared to the last 24, that you guys are thinking of launching a small cap fund. In fact, you've announced it as well. Tell us a bit about it.
Right. So, our belief has been that the small cap space, especially being within the equity spectrum, needs to be recognized quite differently from what we see in the large or the hybrid or the multi-cap, because there are some very distinct features in this space. The first is that it is truly high risk, high return. So the amount of drawdowns that one can see in a small cap can be quite extreme, and we've seen that over many years. So the type of investor who should participate in a fund like this needs to be someone who's aware of the risk in the near term, but does want the opportunity in the medium to long term. So that's one thing which is very different in a small cap fund. The spectrum of risk and return is on the extreme side, which means be prepared for drawdowns which are sharp. The second is that, very interestingly, immediate past performance of the category seems to almost be a contra-indicator of the future, unlike many other sort of classical analysis where we look at one-year returns to decide where we're going to invest over the next few years. So classically, you look at a category and say, oh, this category has provided me great returns and I should put more of that. In the small cap space, if you apply that logic, you're almost, you're likely to go wrong. Because every time past 1 year return was attractive, which is high double digits, let's say, your next 5 year CAGR was very modest at low single digits, 5 years. And every time the last 1 year return was negative or steeply negative, your next 5 year returns were actually quite attractive double digit CAGR. So entry timing in this space can be very, very potent,
sure,
unlike the other categories which are more broad based. So these are 2 or 3 specific risks we want to highlight first to our investors. But having said that, this is the space which provides you the real growth stories, which is what becomes fabled after 8-10 years. So if you look at the real star performers of today, these were really small caps 8-10 years back. That growth phase is what we like. We think that it's always a good time to get into that growth phase, but right now may be quite opportune because price, volume, and valuation is in favor of small caps in our view. Earnings growth has been reasonable.
Sure.
That depends on, of course, across every industry segment that you're looking at. But valuations at some level are trending much lower than average and at a significant discount to the rest of the market. So to someone who wants to take a bit of a contra view, either for the immediate uptrend or for the long term, is aware of the risks, we think this is as good a time as any. Our fund team has a fantastic track record in that space in general. This is, of course, our first and only small cap fund, but that's a capability that we think we've had a lot of experience in, a lot of track record in. So we think combined, this is as good a time as any.
What's it called?
It's called the IDFC Emerging Businesses Fund.
And it's on for subscription.
It's open already from last Monday. It's on for about 2 weeks, and then it becomes open-ended after that.
Okay, great. All the best for that.
Thank you.
Just wondering, Kaustaubh, would you believe, what kind of investor should go in for a small cap fund at the current juncture? Because there is option of multi-caps available as is, which also combine the best of all of the 3 worlds as well. Would you believe, what kind of investor? I'm sure every fund has its merits. So there might be merit in buying a small cap fund or not buying a small cap fund. What kind of investor should opt for such a fund?
Okay, so I think Vishal's kind of articulated that really well, that understanding the risks in these funds is very important. So if I were an investor and looking at some category like this, the first question I would ask myself is, can I take a drawdown as high as 40-50%? And we've seen even more extreme drawdowns at different points of time. So that's the first question, that can I stake it out and say, look, this is a temporary phase. If I stay invested through the market cycle. So one is the ability to kind of digest that drawdown and stay sensible and sane. The other one is obviously a long-term horizon. When I say long-term, ideally to my mind should be about 7-10 years. Because this is really your growth capital. You want to come in for the long term and not, really think about that, okay, can I make quick money in 5 years or not? Because the market cycle could be against you, for an extended period of time. So I think these two things as an investor, you need to be really, really clear in your mind before you get into something like this. Because if you don't have that expectation set, and that's what Vishal spoke about, that explaining those risks upfront to the investor, then the investor is a lot more attuned to when things go wrong. They understand where you're coming from. Because back in 2017, when the mid and small caps were rallying, investors, like Vishal said, looked at one-year returns and came in. They had a very different experience come 2018. But had they, if a lot of them had actually understood, they would have been much more comfortable that this is just a market phase, and let's just tide over it. I think that's really the thing that we should be looking at.
Yeah, it would be foolhardy to ask both of our experts about whether you should do a lump sum or an SIP out here. You can hear various market commentaries on our website or wherever the platform you want to for outlook on small caps, and depending on what your belief and risk appetite is, you could choose that if you want to invest in a fund like this, whether you want to do a large lump sum investment upfront to take advantage of the lower valuations, or you want to go ahead with an SIP structure because, well, these valuations might stay lower for maybe slightly longer as well. So that decision, viewers, I leave to you. We had some queries, but unfortunately we're out of time completely on this leg of the mutual fund show, so maybe we'll try and answer them on the next one. But take a moment to thank both of you gentlemen for joining in today and giving us your thoughts on the various impact that the budget has had on the mutual fund industry.
Great being here. Thank you.
Thank you.
Thank you so much. And viewers, thanks for tuning in to this leg of the mutual fund show.